It's not like single family homes where you need a massive portfolio. That's not how it works, right? 1 or 2 could be life-changing, literally. So we're on the turn right now. 25 is now from a stabilization going up, and 26 is going to get really good, and from there it'll be in a new cycle. Welcome everybody to Self-Storage Income, and Merry Christmas, Happy New Year, Happy Hanukkah, and everything else in between. I hope everybody's having amazing holidays right now. How you doing, Connor?
Doing fantastic, man. Yeah, likewise. It's an amazing time of year. Hopefully everybody's out spending time with family, soaking things up, having a good time, enjoying life, all the things. It's an amazing time of year to sit back, reflect. I know a lot of people are planning for 2025. We're no different. We're looking forward to the future, seeing what we're going to do. And today we've got a special episode of the podcast to actually dive in and help answer a lot of these questions for people starting out, wanting to get clarity on things. And hopefully this really helps set the tone for everybody for their New Year's resolutions, their goals for 2025, gives you the answers you're looking for.
Giving a gift to you guys. We're the Santa Claus of self-storage, passing out presents of knowledge.
Exactly.
And so we have your list right here. We've been looking over Connor's been looking over the list, seeing who's naughty or nice.
Got it.
And seeing what you guys want. And we want to make sure that you guys remember, first of all, how grateful we are for all the listeners. I mean, been doing this podcast now for a long time. Shocked. I'm always shocked at the numbers, like how many people actually listen. It blows me away. It's crazy. We actually love doing this, me and Connor do. And so this is not only fun for us, but it's exciting for us to talk about something that we find so amazing, so interesting, but that's not something you can just go around and talk to a lot of people about because they're like, bro, it's metal boxes. Like, who cares? It's not that big of a deal. Right? Yeah, it is. So we love that all of you out there love it too, that you guys watch, that you guys comment. It really means a lot. We're so grateful that we get the opportunity to share what knowledge we have and what we're learning, how we're messing up and how we're growing. And so really, guys, thank you for participating, meaning that you are asking questions. We do get to read them. We do get to think about. And some of these questions that you guys have asked, I've literally looked in my business and thought about and thought, oh, well, this is a good question. We even had one today, which whoever wrote it will work on your grammar. Now, coming from a dyslexic person, I get it. But the question was awesome. I was like, that's actually a legitimate question. And I want to pile more data from it because I'm like, I would love to see the impact of some of those things. So you guys are asking incredible questions, like you have a thirst for knowledge, and it's just awesome that we get to be talking about this thing that we love. So we hope that you guys, this episode, Connor has gone through and tried to find your guys' questions, things that you want to know. And so, Connor's decided who's naughty or nice, and he'll decide who gets presents this year.
Judge, jury, executioner. Coming in hot. And I made sure to prioritize the best question for the first question here. And this is from Reaper 100. And it says, does a lush beard and high, tight fade increase your cap rate?
This is actually a wonderful question. And I have definitely noticed the correlation between the tightness of the beard, how well the fade goes out. And it's really a ratio, right? It's like you got like your chin to sideburns ratio and then how it goes. And sometimes it gets off. Like sometimes the front gets like way too long and I keep the sides way too short, or other times it evens out. So it's just round. And like Connor has the same thing. Like sometimes he gets his, and as you guys can see, it like fades perfectly down. Those that are watching YouTube, those that aren't.
We try.
He keeps it like really clean. It's like straight and like carved out. But when that gets off, there's absolutely a correlation to the cap rates that we get. Like if we get off for too long, we'll go from buying, a 7 cap. All of a sudden the sellers wanted it at a 6 cap. We got to pay now more for those assets. So great question. And there is a correlation to cap rates and how tight and clean your beard is and how that fade looks.
Don't be slacking on it.
That's right.
Don't slack the beard in the fade.
Great and very serious question.
All right. Let's truly dive in. We have some really great questions we want to get to. We've got Dale M1C. Learned about you through Flip. I'm curious about this. How many people should I contact a day to land a deal? Is it similar to homes as far as 100 offers a month, or should it be 1 to 2 deals? I thought this was a good question because a lot of people are curious what that's going to look like. So what would you recommend? Somebody's starting to cold call, talk to owners, potential sellers, just calling facilities in general. How many calls should they be making?
So this is actually a really good question. And when you're dealing in single family homes, like when you're starting out, it is different. And it's very different for a few reasons. First of all, those single family homes, you have volume, meaning that you could pick a city and there's thousands, tens of thousands of homes you can call on, right? So that same city that has 50,000 homes in this big city, right? There's only 50 to 60,000 storage facilities in the United States. That number is actually higher because if you look at how they even count what a storage facility is and the ones that they don't know about, everything else. But the point is, in that city, you may have hundreds of storage facilities, not tens of thousands. Now, why this is important? There is a volume aspect. Now, you may say when you compare it, wow, there's not a lot of storage facilities. That is actually an incredible amount of assets. 60,000 plus in the United States is an incredible amount of assets. When you look at that compared to Starbucks, like, actual things that we see all the time, they're everywhere. It's so much more. And that is a great thing about this asset class in comparison to commercial real estate. The opportunity in it. Because a huge majority of those two are not like $8+ million assets. The vast majority of them are not. Vast majority of them are actually probably under 2 million, with a lot of them being under $1 million. Lots and lots of those all over the United States. So when you're starting out, the volume game of homes where it's like, we just hit. And I know that if I call 100, I'll get one. It does not equate that way in storage. So instead, you've got to go a different way. I look at it in, there's 3 main ways that we find deals. All 3 avenues, methods that we're finding deals changes depending on the economic cycle. Mm-hmm. So sometimes one way is working good, then another time another way is working good. And I don't ever know which one it's going to be. So we always try to do all 3. But instead of volume, we got to go with magnitude and quality. If I'm doing my direct outreach, I start and I reverse it, and I want to have a target group, and I want to have a specific target group that I'm outreaching. So when it comes to me doing the outreach, like me individually calling, you're playing a little longer game, and you're playing not just will you sell your facility? No, you want to build relations. So I find all the markets I want to be in. I list all the assets in that market. Then I list in every single one of those cities the top 5 assets that I say I want to buy. Then from there, I take all of those, let's call it 50 to 100, and then I want to build relationships. I want to do more than the call. So instead of doing the volume, I'm going to do quality. Instead of spending my time doing 100 calls, maybe I'm writing up an email to talk to one of those owners, but that email isn't about selling. I'm not just asking them to sell, right? So it's a change in how I'd go about it. That's the direct outreach. Another thing that we do is the blind, the volume game. That can be direct mail, okay? That can be mass calls, things like that. That is a totally different game. We're going to automate that more. And basically, you're just looking for a bite. Somebody that says yes. And then once you get one bite, then you're going to go really focused on that one bite. So instead of calling 1,000 homes and getting 100 people that I'm working with every single month, you're not going to do that, right? The next avenue, so we have as far as direct outreach, you have the 2 methods. You have our quality, then quantity. 2 very, very different things you want to do. Quantity, though, it just doesn't seem to yield as good a results. It just doesn't. I mean,
they've gotten bombarded.
Yes,
over the last several
they're
years.
so used to it, right?
Yeah.
And so it just doesn't work as well. Now, the other avenue that we have is brokers. And that is one of the, if not the most important avenue for you. Now, some brokers, you're just not going to get a lot of inroad with because you may be new, and this is a huge brokerage firm that has tons of buyers and everything else, and they're going to go with people they know that can transact. But lots of brokerage firms, especially local ones, things like that, they don't. build relationships with those brokers and make the brokers work. So not just what is coming to you, tell them what you want, be specific, and have them outreach. Then the next avenue is networking. I can't tell you how many deals that we have bought simply from networking. And that is going to local meetups, right? So for example, we had one just about a month ago where we were in New Orleans, and we have, we do our meetups. You want to gather there with other people that are doing it. You want to do association things, right? You want to be in, this is the whole reason we have our community. This is why people are part of Self-Storage Income. They're doing deals together. They're finding deals. People are selling deals. They're getting money. That's a big one, because remember, one makes a huge, huge difference. So it's not like single family homes where you need a massive portfolio. That's not how it works, right? One or two could be life-changing, literally. So, and that's talking about small. If you get any bigger, all it takes is one to be life-changing. So quality over quantity, but that doesn't mean, I think when people hear that, they go, oh, I'm not going to do as much, or I'm not going to do outreach as much. You do, and you need to do lots of it. Different way of going about it. I don't know if that makes sense.
No, I love the focus on quality, because they've been bombarded, a lot of owners. I mean, they're used to getting the calls and the mailers and all these different things. And especially if you're new and you don't have a track record and you're sending out mailers and it's like you've got a little website, but not really any experience. There's just a lot of things there. And then too, with the brokers, like so important there. You said being specific on what you want, super, super important, that they know exactly what your criteria is so that they can send you those awesome deals. And a lot of times too, we found that those brokers who know of something that's about to come on the market, they'll bring it to you prior to the asset even hitting the market, which is a fantastic position to be in. Like you like to say, get in the stream, be the bear, get in front of it. So it makes a ton of sense. I love that.
Right now, financing for real estate is really hard, even for self-storage. The markets are very challenging. Live Oak Bank is a specialist in financing for self-storage, including SBA loans. They are one of the leaders in financing all sorts of deals and deal size. We trust Live Oak Bank for their specialty in self-storage, their unique approach, and how they help their customers go through the process so there's no surprises. That in itself is a testament to their exceptional service and support. So whether you're looking to acquire, build, or expand a storage facility, Live Oak Bank has to be number one on your list to call. Click the link below right now so you can experience the difference that a dedicated self-storage partner can really make.
We've got Charles Scobb, 588. Next question here. Great meeting you in CDA, which is Coeur d'Alene. Yep. Great to meet you too. Thanks for coming, man.
Event.
Yeah, appreciate it.
It's awesome.
Such a great event. Was there any particular strategy or resource you found to be most effective to find your boots on the ground for your remote locations, or just finding boots on the ground? I know we've talked when you guys first started, you used various types of people. How did you guys go about finding those boots on the ground?
So when we're talking boots on the ground, we're talking about there's two functions at a storage facility that you got to do. We have our operational, but then you have your actual asset functionality, which is, so we talk about automation technology, but there is no such thing as a manless storage facility. That doesn't exist. That was a dumb term that people started throwing around. What we're talking about is the man part of it, meaning the asset is an asset. It's a physical location. And even in small facilities, you can have 100+ doors. You can have 100 doors and that facility may be worth $300,000. Okay. So this is like even small ones, you guys, there's lots of things going on. You have gates, right? You have pavement, you have all these doors, locks, and it's a month-to-month thing. You have people moving in and out. So there are maintenance, there is checkups that you have to do. The functions that I think mainly, you have to make sure your gates, doors, and the actual physical part is just functioning, period. Just like it is actually working, that it's clean, that it's taken care of.
Exactly.
Right? The next thing you got to do is what we call lock checks. That means you're checking your rent roll with the locks on the doors. You're actually making sure people are renting, right? And you're doing those things. So it's all together. You have to clean out units. You have to prep them. You have to make sure new people are getting in. Now, this on a smaller facility may not be a ton of work, but it is still a weekly thing, right? This is not something you can't do. So with that in mind, let's say you have a small facility. The bigger you get, this is why we have managers, right? So we have facilities that have 1,200 doors. We have 2 full-time employees at those facilities because there's so much going on. There may be 11 entries and exits. We have one that has a road that goes through the middle of the building. We have another one that's like 4 buildings combined, multiple floors with office and, ships. There, we will not ever not have people there. You can't do it. It's too much. And the income to pay a person compared to what you get out of it because of the revenue of it, it's meaningless. So when we look at that, the smaller those assets go, you have less work, but it still has to happen or the asset's going to fall apart. It's important that you work with somebody that can get there when you need them. Meaning, if you have a local person that is going to help you out, but then they can't ever show up or they're busy doing stuff, and then you go 2-3 weeks, you're in trouble. Like, that's not good. I generally like to find somebody that is okay doing routine things, pulling some weeds, picking up some trash, checking on locks and doors, right? It's not a lot of work, but they can also then, if something needs to be done, they can get it done. You would be shocked though at the people that can do this. Okay. It's like a lot of people. The first thing I do is go to the professions, meaning I would go to like real estate people. So this may be a small property management firm that does like multifamily, things like that. You're like, I'm not asking you to do the operations of the facility at all, but you have a maintenance guy or whatnot. Could they go by, check up things, make sure people are locking, and when somebody moves out, sweep out a unit, and I'll pay you, $300 a month. And it's 1-2 hours a week, maybe, right? They're like, great, that's no problem. We'll do that. Happy to do it. Want to learn about the asset. Other ones is you can find jobs that are seasonal or more periodic. We literally had a guy that what he did was snow removal. And so when there was a snowstorm, we knew, okay, he's going to first actually go remove the snow at our facility. That's a win. So we're like, that's great. We contracted him out to do that. But then 2, on his off time, when there's not snowstorms or when it's off season, he would go to the facility and take care of it. And he generally had more time in those off seasons, right? So he was happy to go down there and provide the functionality. He could figure things out. Not complicated. Call us if there's a problem. I go to that's what I mean by the professions, okay? People that have the availability or can. The next thing you can do, and I'm really not kidding, you can find part-time people or you can find somebody that is retired people are actually really good for this. Retired military is awesome. You go find a retired military person, they retire early because they have their pensions, they served, but they don't want to not be doing things. And you give them a basic list of everything else. But normally when you're dealing with the military, these are responsible people. They can think, they know how to follow processes, things like that, right? I actually love that community. And retired military people, they want to work, they want to do something, but they don't want to do it all the time, right? Those are my main go-to to find those on the ground kind of people. Go to the professions. And then from there, I'd go to retired military. They tend to be younger, dominated in male, which I like because I'm sorry if you think this is sexist, but it's just true. I don't want to be responsible for a female in a storage facility at night and something happened to her because she got called. I don't. So sorry. But so I actually tend to like it to be males. So that way, if they're on site at a storage facility and there's somebody else there, I'm not concerned that something might happen. Sorry.
Yeah, that is what it is there. Handymen are another one that came to mind. I'm glad you mentioned retirees. Handyman firms, it's another one that
handyman firms are great.
Like they're looking for odd jobs to do.
Yeah, handymen are great. So and you can go onto like, what is that site that does like odd jobs and handymans? Oh, not Craigslist.
No,
but I guess Craigslist has them too, but it's like truly, I can't remember. If you guys can remember what it's called, put it in the comments, but you can go find it.
Let us know what it is.
If Connor and I's wife were here, they'd both be like, oh, here's what it is. They would know it, but we can't think of it right now. Say it in the comments, everybody.
Find
for
the thing.
Else. Find the thing. Yeah. Help us out.
All right. Awesome stuff there. SH Dog 56734. Will you all allow accredited investors that are investing below $1 million on a deal still? If so, will it be an interview process to see if they will still be a good fit?
So we do allow accredited investors, and the under $1 million, we do. We've stayed away from institutional capital by choice. So we had a lot of offers. Me and Connor went and met with a lot of people that wanted to write huge checks. Like we met with one in Reno where we did that meetup, everything else. It was like 250 million. And I actually went away from that. I chose not to, because the whole purpose of what I'm doing today is due to our mission, right? And that's financial freedom and giving people access that don't have access to it, right? I didn't need to raise capital. So we made a conscious choice of how we wanted to do it because we didn't need to. It was just a choice. We'd already had our business. So when we do allow accredited investors, we allow accredited investors under $1 million all day long. As far as the interview or what that means, first things first is you have to go through a process. We have an online portal. You have to go through everything else. My team reaches out, right? And we contact you, and we don't want everyone, and we don't want every person. We're not in investing. And I have learned, and I was actually naive about this. If you've never invested directly, you may not quite understand how it works, or you may have a lot of different ideas of what it means to own a business or directly own an asset, right? They're not ATMs. And when you directly invest, you are a owner. Like this isn't like a stock or a bond, or no, you actually own the asset. So you are an equity holder with us. And that means you are going to participate in profit and revenue as it comes in, or what that means. And during bad times, good times, everything else. You're not a bank. You're not a loan. Those people all get paid no matter what, right? And so we just want to make sure everybody's obviously comfortable and that they're okay with that. And I, growing up in cash-based businesses and sales, things like that, that to me was, I didn't know anything else, right? But I know a lot of people, they actually may prefer and be way more comfortable in other assets, investments, and types, and that is okay. So the interview process is more about them understanding what they're investing in. The larger checks we get. So if you're writing an $800,000, $900,000 check, that's different usually because you may be one or two or three investors on one deal. And so that obviously we generally would work a little more to understand and walk through things. Once it gets under 500,000, then you're one of hundreds maybe of investors. Because if you invest 50 or 100,000 and we're raising 20 million, right? You're one of, at that level, a lot of people. And so that is different, obviously.
Mm-hmm. Yeah, no, good answers there. And it's gonna differ as far as that threshold deal to deal. I know we've done 50,000 before, we've done 100,000 before. It really just depends based on the deal. So.
And two, it's important to note that some of our deals, when we go out to investors, everything else, we'll actually only go out to investors that can raise a certain amount. So if you are under $1 million but still over 500,000, you're actually kind of in a separate class because sometimes we have to move fast. So we're going to call 4 investors and we're all going to come in together and we may buy an asset because we don't have the time or the mechanics to go to 200 people. It's like the owner's there. So that is also different in how it may be handled depending on the situation. Developments are different, right? It's each one. And we're getting opportunities as they come.
No, it's so true. So true. All right. Next up, we've got Rico Case. Will shipping containers or drop off at house storage box firms outpace traditional self-storage? What's the climate controlled demand? So kind of 2 questions in there. Yep. But I thought this was a good one. We've talked about this before because it's a constant question in people's minds when they're first jumping into the storage industry. Mm-hmm. They see the storage containers, the on-demand situations, they're dropping it off in front of your house, they're picking it up and storing it for you. How is that going to impact storage? AJ, I'll let you talk to it because
so the first thing is been around for a long time, and that's what people don't realize. So when this happened, actually, I remember a lot of people were like, oh, it was the end of the industry. This is prior to 2008, right? They're like, this is going to take over. And it's going to take not only did that not happen, self-storage not only flourished, it grew way more. And it did not have a corresponding growth rate in those things. And this happened when we had like on demand, meaning people come to your house, pick up stuff and take it back, everything else. They're like, oh, this is the killer of storage, right? This is the Uber of storage. This is the Airbnb of storage, right? And that's, what they're saying. Those never took off either. And it's not that they never took off. They take a percentage of the market, right? But nothing that is not only meaningful, it is basically irrelevant.
I was going to say, it's almost a different market entirely.
It really is.
Utilization's totally different.
Totally different. And those don't have large mass adaptation. And one of the main reasons is to those because of a simple functionality, and that is how you have to run the business. So in storage, people have gone to getting less employees. We use technology to actually drive down cost of employees, where when you start shipping, picking up, things like that, you have to increase your employee base. The economics of that in storage is not good when you're looking at small space, because any cost that goes up has a large impact, obviously, on your profitability, everything else. And so when you start to have to add in all those costs, you have to charge more, and it causes logistics, everything else. So it's a totally different market, and we haven't seen it not only hurt us, I don't think we've even really felt it at all. Yeah. And this has been going on too for a long time. None of these are new. It's not like we said, oh, they don't matter, so don't listen to them. No. When you have new technology and disruptive technology, you should never have your head in the sand. You shouldn't be like a taxi driver. And we weren't. We were actually really on top of it. We looked at how to convert facilities to do on-demand, everything else if we needed to. So how could we switch? How could we do? Because all that matters is what the customers want. Mm-hmm. It doesn't matter what I want. It doesn't matter what I think. It only matters with the customers. The customers, though, over the last 20 plus years have said, this is how we want to use it, even with all those new things and new technologies, because those aren't new now. None of those are new. They've been around for a long time. Mm-hmm. So we just didn't see market acceptance like you did in other industries with those type of things. Storage, it's so localized in how people use it. It's a totally different customer base, and that customer base is not very big.
Yeah, no, I was going to say it really comes back to demand and what the customer wants.
Exactly.
Do they want that type of utilization? Maybe. They might. In that specific market that you're in, maybe it's a super dense urban area, city, something might make sense. But I mean, we've seen, especially whether it's customers or businesses in general, let's say commercial customers and non-commercial customers, the utilization there, they're wanting access at any point in time. They want to come in at 4 a.m., grab their equipment, go out to job sites, do whatever. There's a lot of utilization there that exists in storage as it's been traditionally understood. There's no indication that's going away anytime soon.
To put this into perspective, our tagline, because this is how we felt about our utilization, and when we'd look at it, we'd ask customers forever when we were under our other brand and everything, was we're an extension of your home. Meaning that we're like, we are literally another piece of garage or another big room in your house or a closet or something like that. Mm-hmm. When you look at those other assets and functionality, could the customer use it like that? And when the answer was no, well, that was not the bulk then of our customers, right? Because that's how they used it. And so the functionality was different.
Yeah, no, that's good stuff. Good stuff. Nick Wood, 323. I talked to our IT team specifically for this question because we have a number of different systems, but they asked, do you have a specific camera system that you recommend using for a small facility? And the experts here at our firm suggest you guys use the Unify camera systems. Number of different reasons, very user-friendly, the capabilities of being able to monitor those through different systems, not just a proprietary Unify system, those different things. A lot of benefits there. So I wanted to tackle that for you real quick there, Nick.
We have no affiliation with that, anything else like that. So I want to make sure that's clear. Technology is the name of the game, and how you operate your facility and the efficiency at which you can operate will depend on the technology you use. Your property management system, what it allows you to do, and what you have access will determine the outcome of how that facility performs. That's why we go with Tenant Inc. with their product Hummingbird because they are the best in class. When dealing with automation, when dealing with move-ins, customer acquisition process, improving my online acquisition process, they are bar none the best. So if you are looking to automate your facility or operate it in a best-in-class way, make sure you guys are looking at Tenant Inc. and their product Hummingbird. The link is in the description.
All right, SH Dog, we've got another one here. With self-directed IRAs, do you have to be an accredited investor as well, or just the 100K for initial investments?
So this will always be dependent on how the filing is done, because anytime you're asking for investors, you are under the realms of the SEC. So you are selling a security. A lot of people don't understand this. They think, oh, I'll just put an LLC together and I'll get a lot of investors. So I'm not actually doing a security. I'm not doing anything like that. That is not how the SEC defines it. If you have an LLC and you're putting a bunch of investors together and you're out telling somebody you should invest with me to get this asset, the SEC is going to go, oh, you're selling a security. It's not what it is. It's the functionality of it that determines whether it's a security or not. So they have different laws with securities. And some securities, you can talk and bring on people that are not accredited investors. Other ones you can only do in a certain way and bring on only people that are accredited investors. Mm-hmm. Whether or not it's in a Roth or something like that, right? That's also a different matter. So we do take, like for us, others may or may not, we take retirement accounts, Roths, 401ks, it depends on the person. We got to be very careful because it's not a blank thing. Yeah. So I got to be careful to say that's how it works. It doesn't. So depending on the person's situation, which for us needs to be generally accredited investor. I think we may have one that wasn't, but an accredited investor and the rules of their stuff. We don't get involved in that, meaning that if we may have things that we will do 1031 exchange, or we will allot for you to put your Roth or your IRA in, but you have to do it, as in you have to just make sure it's approved and get in. So because we don't want the liability, but we do accept it.
Yeah, no, very important to cross the T's and dot the I's when it comes to raising capital, getting involved in anything of that nature at all. Go to the SEC website. There's a lot of information there you guys can look at, get a lot of answers there. We've got Be Cheap. They asked the question here, how to fund your first deal. So AJ, man, if you were starting today, how would you fund your first deal?
Right now is a rare opportunity. If it's a first deal, you don't have money. I'm all about the seller finance. I would rather work 3 times as hard to find a seller finance deal and then get friends and family together to put a down payment on it. That's my in today. The reason why is just because that's available today. We find deals. Owners are more willing to do that today. It doesn't mean that it's easy, and it doesn't mean that all of them will, but it exists. Whereas, we went through a period of time where from 2000, probably 16 on, like we didn't see that. Like because of interest rates were so low, people are like, no, just cash me out. So there is a period right now due to high interest rates, sellers wanting to sell, but not having a lot of options that's available. And so I would use that time. I would really try to find that. If not, I would go and we work with Live Oak Bank. I'm literally going to talk to Live Oak Bank tomorrow when this is being filmed, not on Christmas, but to go see them. And we like working with them because they know the industry, one, but more importantly, they have the underwriting capabilities from the government to do SBA loans. So if you go to a bank, all of them are going to say, oh yeah, we do SBA loans. That doesn't mean they underwrite it though and have approval process. That is very different. All they're saying is we allow it. And so we give you the paperwork, then they send it to somebody and then that person may not approve it because Live Oak Bank actually does the approval process for the government. They walk through with you and they're going to tell you if it'll be approved or not. The thing I hated about SBA loans is you'd work for 3 months, send it in, and then it wouldn't be approved. And you're like, I just wasted, like, what in the world? Now I'm in trouble, right?
Yeah.
So that is one of the biggest risks with that product. That's why we like going with somebody that has the underwriting capabilities and can help you. That's because you get a lower amount down. Now, I am nervous, though, about financing today at high interest rates and not being able to refinance or have huge penalties. So I watch out for that. But if I don't have money, that's another way you could go about it. The problem with that is the DCR, debt coverage ratio. If you're only putting 10% down, the amount you have to pay to cover the debt loan at today's interest rates is going to be big. What that means then is the bank's going to look at it and say, how much you have to pay to how much this is bringing in. It's skewed. Even if the 10% would work, the payment, right, doesn't. So SBA loan, I would, but it can be a little tougher right now. Mm-hmm. Other than that, localized banks, friends and family, going and buying one, and just a straight out purchase with a local credit union or bank is also another favorite one of mine. If I'm doing something bigger, I would do an accreditation. I'd pool and I'd either go get one financing partner and just do a straight partnership. I got a money guy, not friends or family, not anything else. I have a money guy, and then I go get a bank loan, or I go get more of a hard money kind of thing. I pay a higher interest rate, but they essentially are becoming the bank, right? And you have to be careful with hard money loans. They're not all the same. It can be more of a wild, wild west. I'd get a professional to help me. So I'm not suggesting people go do that, but there are actually lots of good products in today's environment. So there's lots of ways to skin a cat. Okay. Mm-hmm. If we're talking about the down payment, not the financing side, friends and family. Okay. Or I would go and find a money guy, an investor. That's what they do. And you may say, well, I don't know any of those. Well, nobody does. That's like, I mean, literally one of the main functionalities we do is trying to get people to get us money. They're called investors, right? Yeah. So yeah, go onto the forums, go to local real estate meetups, go start getting in part of communities. There are investors all over there that this is what they do full time, meaning that they have to invest or their job doesn't work, or they have to invest or they don't have assets. They don't want to run them. They don't want to do anything. So they're actually looking for opportunities to deploy.
For sure.
I'd find an opportunity, then get the money, then get the financing.
Mm-hmm. No, really good points. And find people that have done it before. Go out, find those people that are familiar with the process. Again, those people that are, I mean, there's people out there right now today that are just hard money lenders. It's like literally what they do. So reach out to those people. SBA is a fantastic deal. And I wanted to hit on this too, that purchasing a storage facility, again, you're purchasing a business, but you've got the real estate aspect behind it, which is fantastic because you have the collateral that going in, because if you're going in to buy another business that doesn't have a whole lot of collateral, then you run into those issues of potential approvals with SBA. Whereas again, storage, you've got the business and the real estate aspect along with it. Banks feel a lot more comfortable with it. And again, you've got the collateral to cover any downside you guys might have. So just important aspects in why we love storage so much. Next question that we've got here: how do you transition and train customers that are older that may not use or want to use technology like apps and Bluetooth or the no-key system? Also, will your 2.0 book be on Audible soon?
Great questions. Thank you for reminding me about the audio. So we are actually been working on that, and hopefully that will be out here soon. Now, one of the things that we're looking with this was a huge concern that I had. The first time that we did no key, it was not in the market. It didn't exist. So we went, and I went with Janice and no key, and we went on site. And Christine over there, she worked with me, and we actually had problems because nobody had ever done it. They hadn't done it. And Christine actually came, even on site, she came from like Atlanta to help me out. And we went and walked through the facility, and we were trying to figure out how this would work. And so I had a lot of concerns outside the functionality, things like that, which that was however long ago now. So we're talking about version 0, right? They're on version 7, which is incredible and so easy. So even back then, when we were trying to figure out the functionality, I was like, well, how are we going to interface in this location that we were trying to do this in was a location that had lots of retirees. So this was, we were actually having kind of a debate about it and everything. Well, what we found out was, first of all, the boomers spend more time on social media and mobile phones than the younger generations do, by the way. Crazy, but they do. So the next thing was strange, but an 80-year-old woman with frail hands does not like to have to get a padlock or a big lock and key and open it and try to close it and get those metal slider things open. The online capabilities, the Bluetooth, the ease, but not having to deal with the lock and stuff, they actually liked it the most. Now, if they didn't do the cell phone and everything, they have a key fob. So then it's like a gym where they just use the key fob. So either way, we found that the people that liked it the most were the older generation. The younger generation, they were like, oh yeah, this is cool because I like tech. But it wasn't something that they're like, outside cool and smooth and good, functionally, I have no problem opening a lock and opening a door. That wasn't something they thought a lot about. Where the older generation, they were actually like, no, this is really nice because this hurts my hands, or I get worried about it because this door, how it moves open, everything, trying to get in. And all those kind of things where they had a fob. And the fob, they just passed it over and it opened up. So I had a big concern with that. I know a lot of people do. Reality was, though, even in those old models, before the first one, the largest feedback we got positive was from the older generation.
That's such good feedback, man. And all the things that you just said when you're talking to customers is a perfect way to sell that. Talk about all the benefits of it, the ease of use, all of those things, because that's an important thing too, is don't make it seem like, don't not sell it. Don't make it when you're talking to customers or your employees are talking to customers, make sure that they're selling that capability as this huge benefit, this huge positive. The security aspect alone of no key is huge, where people can't just go and cut locks and get into units. Like those things are such
the older generation love that.
Yes.
Like we can see and we know that security and we know who's in the facility. So that's another big one. You can't get into this facility, right, unless the electronic mechanism, you have the electronic key, right, or key fob stuff, but it actually tells our system who's coming in and out. We know all the approvals, who's the individuals that can do it. So it's not just, you have a key or a combo that I just gave to anybody, right? It doesn't work like that. So the security aspect too, the older generation really liked, as in we know who's in there. And so when you're in there, they're not texting out their gate code to 15 people, say, hey, if you never need to get in there, just go. You can't do that with those systems.
It's a huge, huge benefit. Brent Castro, question here. I thought this was a good one. How many vacant units or percentage of stock should a facility try to keep in inventory at any given month?
10 to 15%. So when we start to get over 85%, we start get aggressive on rates. When we're over 90%, we're actually trying to kick people out. So you should never be at 100% ever, because you cannot adapt and you can actually get stuck. And so it's not good. You need to sell product. You need to have it open, right? You need to see what demand is even there. If you have 100%, you've always had 100%, you actually may not recognize the demand. You may not understand pricing, things like that. So we always want, but we target for like 87, 88% occupancy is what we target. Once we start to get over that, definitely over 90% though, we're like, okay, we need to open up inventory. And that can be on individual unit types, not your facility as a whole. Meaning you could have, out of 6 unit types, everybody, you could have 5 that are 100% full and then 1 that's 30% occupied. And all of a sudden your overall occupancy looks like it's 88%. But that's actually not true. 80% of the unit types are 100% full. So you have no inventory for the actual most demand units. And the one that you have the least demand, you have inventory. Not where you want to be.
Yes, no, get granular for sure. Good question here. I've noticed that, and this is from Oswald Fife. I've noticed that the storage facility prices and rent rise and fall across all storage facilities at the exact same time. Entirely different companies. How does that happen?
All right. So there's a few things going on. First of all, there's seasonality to storage. So normally speaking, we will see rates change based upon seasonality. It is following customer demand. As demand lifts, occupancy goes up, rates go up. As you move into the fall and winter, occupancy goes down, rates go down. So generally we see this pattern. But the other part of it is competitors are trying to price each other. And technology has played a big role in this. So technology, we can see pricing. You can see online stuff and you're looking at it in real time, what's happening. So the technology is tracking and pricing predicated on competitors. So if you go online and you look, you may see 10 facilities and they're all within a $5 range, right? And then as they go down, they all go down because they're trying to compete for that customer and that customer is looking at them. When we have vacancy, storage is very commoditized, right? So there's this aspect about it when you get oversupplied that it's just, they all rise and fall at the same time. That changes wildly though once the tenants are in the facility. Then prices aren't the same at all. And so what they're doing is everyone's competing on acquisition through price. Not everyone, but a lot of the competitors do. That's not a good spot to be in. That's not what you want to do. And surprisingly, you don't have to do that. But that's a conversation for a whole podcast.
It is. Well, and talking to that, we don't have time to get to all of these incredible questions, but we've got 3 more that I definitely want to hit. What tools do we use to check market saturation level? I'd love to just break out what tools do we use to really analyze markets.
Radius. Honestly, we look at Google. You go and actually find there's online scrubbers that we can use. And there's a handful of these online products.
ESRI.
Yep. Exactly. That we can actually look in the market, see what's going on. That a lot of them, though, you pay for either a credit system or you have to pay a full amount. There's software, there's lots of ones. But if you're in smaller markets, it doesn't have REITs, everything else, the easiest way, you guys, and the most efficient way that is actually correct, because just because they're scrubbing data, it doesn't mean they're getting all of it. 100%. And it doesn't even mean they're always right. So especially if you're in a small market, go online and call the facilities. If you're in a small market and there's 5 facilities, it's 5 phone calls. Go walk in and go call. It is still the best method to understand market saturation, by understanding who has what and what they're selling. In big markets where you're trying to analyze trends and big things, that's where the software really comes into play. Still though, we would still go do that. Mm-hmm. My son, actually, Tristan, he sits in here and that's what he does. He calls, he's 14, well, he just turned 15, and he calls after school, he comes in and he calls competitors and he does competitor tracking and analysis, and he plugs in rates and looks at the rate spreads. So he sits in here in the afternoon and calls up competitors. You just can't beat that.
You can't. Next question we've got is what software do you recommend to manage your storage facilities?
We use Hummingbird, Tenant Inc., and obviously, we use it because we were some of the founding members. We are the largest investor in it, and we built it specifically for the needs of storage people. So we had large storage facility companies, and the Store Local founding, which was the national association years ago, were like, we can't get software companies to do what we need, and we're not getting the functionality that we need to compete at a level we need. Mm-hmm. So they just literally built a product. We all built it.
Well, you're giving all your data away to competitors.
Open sourced. Right? Oh yeah. The competitors on it because they're owned by other people. So we're like, nope, this one we open source. So you own your own data. Mm-hmm. So you come in, you get it. It's open. You can use it, but it was designed for storage owners. That's it. It wasn't a tech company that got into storage. You're talking about 100 storage operators got together, and they went and hired and put their first round of $30 million into a storage tech product. I think they've raised over $45 million to develop a software management system. So this one is the only product in the world that was made by storage people for storage people. And we did it so you could do things like small facilities and automation, right? As well as the big mega facilities, which we have. We've got some of our owners and people that are on it, $2-3 billion of assets that are through, California, New York, right? Huge mega facilities down to all the small guys. That's actually the bulk of what we do because it's made to be easy and do analytics and things that we can't get, but also help with automation. Mm-hmm. And so that's why we suggest it. I've used all the other ones and there's nothing wrong. Like, I want to make sure this is clear. When you look at the other products out there, they're all different. And we needed something that fit for us. We needed to own our data, and we needed it to work really, really well and not be an individual product for individual people and just here's what you get. That's why we did it. And frankly, the way it's revolutionized our business from any other product we have is quite incredible.
Yeah, it really is. It really is. And the last question is actually from yours truly here. I wanted to get an outlook, AJ, just high level snapshot. What do you see happening in the storage industry in 2025? Where do you think the opportunities are going to be? The pitfalls are going to be? Just snapshot 2025. What are you thinking?
So I'm still holding to what I talked about in 21 and the first quarter of 22. So in 21 and 22, crazy that that's like 4 years ago.
Yeah.
But we said out there, and I outlined it, and we've talked about this repeatedly because I go back to it because that was our outlook, and I want to make sure it got so many people, millions of people read it and went into it that I'm like, I keep going back to say, is it changed? Because it's still out there. But we laid out, we said, all right, interest rates, we believed were going to go up, and they're going to go up a lot. And then we believed that was going to stagnate the housing market. It wouldn't crash the housing market, and it would stagnate it, meaning that homes weren't going to transact. And so we believed that the asset side of storage would more freeze because of interest rates, meaning sellers wouldn't sell as much. Basically, I called it the self-storage bubble. The crazy prices that people were getting, that was going to go away, and that sellers were going to be real sellers, but they'd have to come back down to earth on what they were asking. So we believed that would slow down on that part. The mega acquisitions that we were seeing of billions and billions of dollars. Today, it's more the small beginners, intermediate operators, right, that are actually buying and doing things. You're not seeing $2 billion portfolio sell. So we thought that'll go away. But then we also knew that demand would soften because the housing market would slow down. From there, we said 2022, we were going to see a shift. 2023 and 2024, we said 23 was going to suck. And various others could be really bad. It was. 24 then we said was going to be a stabilizing year. It was. 24, we saw the stabilization of our industry as far as rents, occupancies, things like that go, right? It was no longer people were like, it's like, okay, we can see what's going on.
Getting back to a norm.
Yep. 25, we said it was going to start to get good again. As far as we were going to see more demand pickup. Not that it's not good, but that demand was going to pick up more. And then 26 was going to be back into heightened demand. This also had to do with the fact that we were going to see a fall off of development. So due to high interest rates, you're going to stop seeing development. So over time, demand would actually get bigger. Mm-hmm. So I'm still holding true to that with the caveat, which I've said all the time, it all depends on interest rates. So right now we're finding on the acquisition side, we're finding the best deals we've seen in a decade. So we love that. I don't want that to actually change. I want to be able to acquire deals at these amazing prices. We're not acquiring the volume, tons more, but the ones that we're acquiring are just awesome. They're quality. These are great deals. And I want that to continue. But I also want our facilities that we own and operate, that Connor's looking at every day, to be like, wow, we just have so much demand. We're just lifting prices, things like that. 2025, we will see occupancy and rents go up. It will not be, though, crazy like it had been from 2018 to 22, which was just nuts. Mm. And that's not bad, everybody. That's actually good. That should not be the expectation. I hope that we do not see a 2020, 21, and 22 again. That actually was really bad. But I think we will see that increased demand pick up. We will start to see more larger transactions start to go into place. And we will start to see the effects next year of development that hasn't come out. Areas that had development that were in the pipeline that came out in 23, 24, and then 25, they will see the impact of it, meaning it's going to soften occupancy and rates in those individual 3-mile radiuses. Places that don't have a lot of new inventory stuff, though, they're going to be coming back stronger. So we're on the turn right now. That's what we believe. And the 25 is now from a stabilization going up, and 26, it's going to get really good. And from there, it'll be in a new cycle. We are entering in the new cycle. That's exciting for me. We have been raising money like crazy. The amount of travel that I did this year, my poor wife, it was crazy. It was a lot. Yeah. And it was like, because I'm like, we got to get lots of money because this is the opportunities here.
Go time.
We got to take advantage of it. It's not like crazy interest in storage like it was. Like the feverish, storage. That's finally come down. Thank goodness. That was out of hand. All those things are great and shows us that we're moving into the new cycle. The caveat being interest rates. If the economy starts to pick up and interest rates have to go back up, it just means the rate of growth will be slow. So how much demand, occupancy, and how much growth we have in 25, that's what it's predicated on. How fast interest rates will go down. That's it. if interest rates stay where they're at, growth will just be growth. We'll see increased demand, we'll see increase, but it's not going to be overwhelming anything else. 30-year mortgages hit 5 or below, that will change our world rapidly.
Yeah, no, I couldn't agree more. Couldn't agree more. So keep your eyes open, folks, for 2025. Regardless, the opportunities are out there. Make the calls, build the relationships, get out there, get the deals done, raise the money, whatever it takes, do it.
Do it.
It's worth it.
Thanks, everybody. Merry Christmas.